Today's focus, all the US-based funds have gone completely flat, while a lending frenzy has erupted around Ethereum. Bitcoin has dropped 30% in just 4 days. Now it's crystal clear who's been swimming naked and who's left holding the bag. But the real question is, if you get in now, are you just another gambler or could you be a winner? Thursday, Feb 4th, BitcoinTV Chinese. Where's Bitcoin? I'm Michael. Watch the data 24/7 now. Let's check the measuring stick of the heavens, the Bitcoin logarithmic cycle Z-score. This indicator isn't meant for catching short-term moves or market turning points. It's specifically designed to determine whether Bitcoin is currently extremely overpriced or ridiculously undervalued. At around the $73,000 level for Bitcoin, the logarithmic cycle Z-score has already dropped to minus 2.24. This is the deepest drop since the major shakeout in 2022. Looking at this data, it means that the current price is severely undervalued. Don't be intimidated by how scary the market looks right now. Back in 2019 and 2020, this indicator even dipped below -2, which basically meant that those who were panic selling had almost completely dumped their holdings. It was a signal to start entering the market and cleaning up the battlefield before the next rally. So this negative 2.24 is not telling you that the sky is falling. It is telling you that this wave of overheated sentiment is almost at its peak. Holding at the current price carries much less risk than before. All that is left is a bit of patience to get through this grinding period. Let's look at another indicator, which is the Coinbase Premium Index. The essence of this indicator isn't about the price itself, but rather whether institutional and high net worth capital in the US are actually putting money in to buy on Coinbase's spot market. This is a very crucial indicator for determining whether US capital is entering the market. As of now, this indicator has already dropped below negative 0.2%. Since December 16th of last year, this indicator hasn't even glanced above the zero line. The premium has been negative for a long time. This shows that American capital hasn't even planned to step in and take over yet. So, under this kind of capital structure, the market may occasionally rebound, but it's mostly driven by contract funds and non-American liquidity, not by spot trading. There isn't really genuine demand or real money propping it up. So even though the trend still looks like it could rise, the confidence behind it isn't very strong. Once sentiment cools down, it's especially easy to give back profits. So right now, we're in a relatively weak trading range, which also shows that the overall market risk appetite is still conservative. People would rather keep their money in stablecoins than rush into the market. This actually matches what everyone is seeing on-chain. The demand side hasn't returned yet, and the main capital is still waiting on the sidelines. When it comes to trends, the signal that truly deserves attention isn't a single rebound candlestick, but whether the Coinbase premium can return above zero and hold steady. As long as this condition hasn't appeared, the market is still most likely in a choppy rebound phase. The main focus is on digesting the structure. This January, there were a few more people borrowing money on-chain, but compared to the frenzy back in 2025, this is at most just a slight recovery at the bottom. Now that there's some momentum, people are borrowing stablecoins on Aave 3, mainly for survival strategies or small-scale arbitrage. No one dares to leverage up in a big way anymore. Now let's look at the data from Nexo. In January, people withdrew $24 million to spend, which is a 9% increase from last month, but it's still far from the lively days. What's interesting is that people seem to prefer using ETH as collateral to do things. There was a total of 1 million ETH borrowed, nearly double last month's amount, and as a result, the staking ratio of the entire Ethereum network has risen to 12%. In comparison, Bitcoin is still the most stable, accounting for 56% of the total collateral. It's clear that everyone is being very cautious about borrowing on-chain, so you really can't expect people to jump in boldly in the current market. Right now, it feels more like patching up the holes after a major drop. As long as the scale of borrowing hasn't returned to 2025 levels, everyone needs to remain cautious in this market. Now that we've finished organizing the data, let's take a look at the news. For new viewers to this channel, let me explain. Here, we help you sort through all the major events in the crypto world over the past 24 hours. Whether it's small things about big projects or big things about small projects, we'll keep an eye on them for you. People always say you can't earn money beyond your level of understanding, right? Well, this is your gateway to improving your knowledge and your Web3 awareness from a news perspective. Let's check out the news. At this stage, the crypto market is essentially being battered by liquidity issues. Bitcoin has been sliding all the way down, hitting as low as 71,800, and Ethereum has also dropped to just a little over 2,000. But what's really deadly? We've had 4 consecutive days of both long and short liquidations. If you tally it up, Nearly 100,000 people have been liquidated. What does this indicate? Right now, it's not just about prices going up or down, it's that money is pulling out. Order books are thinning, precious metals are moving first, macro funds are tightening, and the buying side just can't support the crypto world. Naturally, it became the first layer to be drained. Now the real question the market cares about is, if prices keep dropping like this, will there be anyone left willing to step in and buy? Alright, let's put it in the comments. If Bitcoin drops to the 60,000s, would you buy? What about if it drops to the 50,000s, would you buy? Or the 40,000s, or even the 30,000s, would you buy then? The comment section is yours.
U.S. Treasury Secretary Scott Bessent has made it clear that the Treasury will not, and does not have the authority to, use taxpayer money to bail out Bitcoin. The U.S. strategic Bitcoin reserves only consist of assets seized by law enforcement agencies. There will be no new budget, and the government will not intervene to support the market. Even though the government has suspended the auction of seized Bitcoin and is now holding it for the long term, the core principle remains budget neutrality, with no backstop for the market.
Oh, that is an asset of the U.S. It's an asset of the U.S. Are you going to invest in it? And I will point out, Mr. Secretary, reclaiming my time, are you going to invest in the seizure? That $1 billion in Bitcoin was seized, $500 million was retained, and that $500 million has now grown to over $15 billion.
New data indicates that some bottom structure signals are gradually recovering. Bitcoin's overall return over the past 2 years has been close to zero, which means that high-price positions have been fully digested and there are no signs of a mass exodus among long-term holders. Provided that the support level can be maintained, the current price range is showing an improving risk-reward structure for medium to long-term capital.
All right, Scott Bessent made it clear. The US government can use Bitcoin as a bottom drawer asset, but if it really crashes hard, don't expect the Federal Reserve to step in and bail out the market. When it comes to Bitcoin, you won't get a single cent. So now everyone should understand that Bitcoin's status is nowhere near being the government's favored child, not even an adopted one. At best, it's a wild kid living a tough life, especially during a bear market downturn when there's no pain, there's no love from anyone, right? The price is entirely driven by everyone's emotions. But on the other hand, this is exactly the kind of rite of passage that a legitimate asset should go through. Only assets that can truly withstand downturns, come back from the dead, and be reborn from the ashes are worth holding across cycles. Yesterday, an old miner who used to mine with us in the early days and is also an experienced media person asked me, do you think Bitcoin could really drop to the 60,000s or even the 50,000s? I said, from a technical perspective, it's possible. He replied, Bitcoin really tests people, doesn't it? It seems like holding on to Bitcoin is truly a test of patience. Most people just can't hold on. They surrender and give up early. If you're one of our gold members, then when Bitcoin was at 95,000, you should have followed our weekly review and reduced your holdings by more than 80%. In fact, every rebound is a good opportunity for everyone to reduce their positions and exit in the short term from a technical perspective. If you followed our strategy, then in this round of decline, those holding spot positions actually haven't lost. Of course, our own selling isn't significant enough to make headlines, but if MicroStrategy were to sell its Bitcoin holdings, that would be a big deal. Of course, Michael Saylor has said that if the price drops, it's an opportunity, and he would buy in again. However, GameStop has cleared out all of its Bitcoin holdings.
According to the data, GameStop has liquidated about 4,710 Bitcoins, cashing out approximately $450 million, and has officially exited the corporate treasury camp. Its CEO, Ryan Cohen, said that they have found a more attractive strategy, which stands in contrast to Michael Saylor, the founder of MicroStrategy. In the face of a more than 30% pullback by the end of 2025, Michael Saylor not only did not reduce his holdings, but continued to buy during the downturn, viewing it as an opportunity.
All right, GameStop has cleared out all of its Bitcoin holdings, which is a very negative signal at the level of publicly listed companies. Now the pressure is back on MicroStrategy. Can it withstand the decline? When will Michael Saylor sell next? So everyone's confidence in the entire market would be even worse. That's why when people talk about long-term value and long-termism in the current market, the definition of long-term varies from person to person. For some, it means 4 years or maybe half a year or 2 years. In reality, the only ones who could have captured Bitcoin's over 10 million-fold increase are those who never bought any from the very beginning until now. But in the face of profit, how many people can really hold on?
As of January, Strategy still holds the top spot among global companies in terms of Bitcoin treasury. A single company's holdings have already exceeded 3% of the total circulating supply. In the second tier are mining company Marathon Holdings with about 53,000 coins and 21 Capital with around 43,500 coins. While over 150 companies still disclose holdings, those withstanding long-term volatility and financing pressure are decreasing. The corporate Bitcoin treasury is concentrating at the top as weaker players exit.
So in the coming cycle, Bitcoin won't reward those who talk the toughest or claim to have the strongest conviction. Instead, it will favor those who can still breathe normally in an environment of high volatility and low liquidity, where no one is there to bail you out. To put it bluntly, many people aren't defeated by the market itself, but by their own misunderstanding that holding long-term means just stubbornly holding on. They end up eliminating themselves. So next time, Bitcoin certainly won't lack believers or followers. Instead, it will start choosing who is truly qualified to hold it. In the end, those who remain in the Bitcoin world may not be the most optimistic or the most knowledgeable, but they will definitely be the ones who figured out this logic the earliest. It all comes down to how long you can actually hold. He's fighting a tough battle on one side while being watched closely as he ventures into new fields. Those who aren't convinced can come and see what he's really made of. As the giants of the prediction market start to battle it out on the snowy streets of New York, tearing into each other, is Polymarket, Binance, or Robinhood just sitting back and reaping the benefits? Alright, let's turn our attention to stablecoins. When it comes to USDT, its parent company Tether is definitely the aircraft carrier of the entire industry, because it's the biggest in scale, and its finances are notoriously opaque, which has always drawn skepticism. But somehow it just won't die. So, what is everyone busy doing now? They're busy trying to get a piece of the inclusive finance pie. Just look at what they're doing. On one hand, they've open-sourced Mini-OS, aiming to lower the barrier for mining. On the other hand, they've teamed up with Opera to promote stablecoins in emerging markets through MiniPay. Their goal is very clear: to push stablecoins into payment and settlement scenarios. So, precisely because USDT is now being used in more and more commercial scenarios, Tether's financial situation and its expansion logic are coming under greater scrutiny. Last fall, a rumor about Tether seeking financing resurfaced. If you're making so much money, why do you need to raise funds?
How we can demonstrate how agricultural companies and producers of commodities like wheat, rice, milk, and companies like ours at the Guard can use stable coins like USDT for international trade. The co-agers sell their products to Asia and to the United States. In order to make these sales more efficient, they are starting to look into using stablecoins like USDT to do so.
Tether denied it. Plans once aimed for $20 billion. CEO Paulo Arduino called that figure a scenario upper limit, maintaining a $50 billion valuation. In 2025, Tether's profit should hit $10 billion, down 23% year-on-year. But it remains a rare, highly profitable company in the crypto industry. USDT's market value is about $185.3 billion, with approximately $2.5 billion in profits, and it holds around 130 metric tons of physical gold. At the same time, the launch of a compliant stablecoin, USAT, targeting the US market, along with multiple business expansions, provides support for its valuation.
Up until now, the company's USDT has always been questioned, with doubts about whether its reserves are sufficient for redemption. But if you look at Tether's recent investment tracks, what are they aiming for? They want to become the provider of hydropower mining payments in the crypto world. They want a piece of both old money and emerging markets. They claim they don't need financing, but their valuation is at $500 billion and hasn't dropped at all. The core message is simple: I don't need money, and I don't want anyone to undervalue me. So this is Tether's development path, paving their own way and leaving no room for others. On the other hand, Doco is taking the path of the regular army, embracing compliance and regulation. So, while it looks like the two companies are heading in different directions, in reality, they're both fighting for the same seat. What seat is that? In the next cycle, who will become the underlying standard for stablecoins? Have you noticed that concepts like B-share linkage and RWA aren't as hot anymore? So, what's the hottest concept right now? There's nothing wrong with prediction markets. As long as the outcome hasn't been decided yet, there will always be capital engaging in this kind of game. But what's the reality? Things like elections, whether the Federal Reserve will raise interest rates, or even sports games, all of these can become chips for on-chain betting. So, prediction markets are essentially about pricing information and pricing outcomes. I think at this point, the gambling veterans might say, well, hey, I shouldn't have called it gambling back then. I should have called it a prediction market. But in essence, they're actually the same thing. But nowadays, prediction markets aren't so easy to operate either. The reality is that prediction markets are having a tough time too. Regulators have started keeping a close eye on this emerging market, and the cost of acquiring users is getting higher by the day. Just putting out a few sponsored articles and handing out some airdrops isn't enough to keep those savvy veterans in the crypto world around anymore. So now, CEOs of various prediction market platforms are all focused on figuring out how to become part of people's daily lives. Maybe you could open a betting pool in your area too, whether it will rain today or if there will be a sandstorm tomorrow. All of that can be priced. So what they need to consider is, where is the traffic? Where is the breakout traffic? They have to find ways to turn this business into an indispensable pricing engine for everyone, and everyone wants to be the one who ultimately holds the right to interpret and the power to set prices.
Now, moving even further into the mainstream, Google announcing it will integrate Kalshi's data into their search results has sparked new debate over whether the line between prediction investing and gambling has become murkier and murkier.
Prediction market giants Kalshi and Polymarket are competing for the New York offline market. On February 4th, Kalshi handed out up to $50 in free groceries in Manhattan, attracting thousands of participants. At the same time, Polymarket announced the opening of a long-term grocery store and donated $1 million to the New York Food Bank. Today, both platforms' daily volume exceeds $400 million, up 400% lately. By 2025, Kalshi should net $263.5 million in fees, with a multi-billion-dollar valuation. Though Polymarket leads, its market share is shrinking.
On one hand, Polymarket has been blocked and banned in many countries and regions, including Singapore, where it can't be accessed. But on the other hand, we see that traditional giants like Opinion, Robinhood, and Kraken are all making moves into the prediction market space. What does this mean? To put it simply, these two prediction markets are handing out small gifts and food to people outside supermarkets in New York. What they're really doing is taking advantage of the fact that people are still confused and don't yet know what prediction markets are. They're trying to grab users and territory first. In essence, everyone wants to transform from a simple betting platform into a social information hub. So in this competition where everyone is qualified to participate and no one can afford to lose, as long as the halftime whistle hasn't blown, no one dares to relax, let alone breathe a sigh of relief. That's why the prediction market will keep getting more and more intense. Now let's look at the latest news.
This time, it's people from within the Bitcoin community turning on each other. Bitcoin developer Luke Dashter directly called out Blockstream's co-founder and CEO, Adam Back, saying he should step down. The reason isn't about technical direction, but rather the Epstein files, which have dragged external risks into the core of the industry. Recently, some people in the foreign community have been calling for a coordinated withdrawal from Binance to see if the platform can withstand the pressure. He, Binance's co-founder, simply made it clear, just treat this as a stress test. If the platform can withstand it, that actually proves its strength. According to on-chain data, Vitalik Buterin has converted nearly 2,800 ETH into cash over the past few days, totaling over $6 million. The selling price was not particularly high or low, so it does not look like he is cashing out to leave. It is more like a move from someone familiar with the space. As always, he donates when he should. This time, the US ICC directly named 3 crypto companies. They accused them of using algorithms to fake transactions, creating the illusion of trading volume for retail investors. To put it bluntly, the excitement is fake, but the bag holders are real. Gold clearly missed the mark this time, with prices plunging below the $4,800 mark, dropping $170 in a single day, a decline of over 3%. Even safe haven assets are starting to buckle under the pressure of volatility.
Many retail investors, when they see a drop, their first reaction isn't to think about risk, but to say, here comes an opportunity. As soon as the price pulls back, they immediately start looking for reasons to buy the dip, as if buying low automatically means safety. But if we look at the pullback in 2026, in fact, it's long since stopped being just a matter of emotional panic. It's more about structural repricing. Macro liquidity is tightening, regulations are being redrawn, and capital preferences are shifting. All three of these things are happening at the same time. So, a cheap price does not equal lower risk. This could mean that the logic that previously defined the rules has already become invalid. What you see might look like a discount, but what the market is actually doing is a complete overhaul. The real danger isn't the drop in prices, but that you're still using old bull and bear market thinking to interpret prices in a new cycle. So, a pullback has never been a signal. Structure is what matters. If the structure isn't stable, then what about the so-called bottom range? It's just a price range for others to rotate their positions, not a place for you to sleep soundly at night. By 2026, the ones who survive won't be those best at buying the dip, but those who can hold back, truly understand the structure, and read the market. Alright, that's all for today's program. Included here are our membership benefits. We hope you'll take a look. Tonight is Thursday at 8 o'clock, our regular unmissable member live stream. Whatever questions you have, we'll address them one-on-one. Let's work hard together and gradually become wealthier. See you tomorrow.